Hey everyone, and welcome to this explainer. Today, we are taking on an absolute giant in the financial world. We're talking about Benjamin Graham's legendary book, The Intelligent Investor. This is a book so powerful that Warren Buffett himself literally calls it the best book on investing ever written. Our goal today is to demystify its core concepts and break them down for you. It's great to have you with us.
So, let's just start right out of the gate with the big question, right? What is the actual secret to successful investing? Because if you turn on the news or, scroll through your social media feeds, you might totally believe it's about having a crystal ball, perfectly predicting the future, or somehow magically finding that next hot stock before anybody else does. But Benjamin Graham, well, he tells us something entirely different.
Okay, let's dive into this. Here is the exact roadmap we'll take to understand Graham's foundational principles. First, the secret to investing. Second, meet Mr. Market. Third, investing versus speculation. Fourth, your margin of safety. Fifth, two types of investors. And finally, mastering your emotions.
Let's jump right into Section 1, the secret to investing, beyond the crystal ball.
Turns out, Graham's central thesis isn't really a secret at all. It basically boils down to three core pillars: making rational decisions, meticulously managing your risk, and thinking long-term. Actually, scratch that. It's really about actively stripping away the excitement and the reliance on luck. The true formula for success relies entirely on your knowledge and your consistency, rather than playing guessing games with the market.
Moving right along to Section 2, meet Mr. Market, your daily business partner.
To really understand market fluctuations, Graham uses this brilliant allegory. Imagine you have a business partner, and his name is Mr. Market. Every single day, without fail, he knocks on your door and offers to either buy your share of the company or sell you his. But here's the catch. Mr. Market is highly emotional. Honestly, the guy might need a therapist. On some days, he is incredibly optimistic about the future of the business. And when he's in this euphoric, high-flying mood, he offers you absolutely sky-high prices for your shares. His emotions are completely driving the price up, which makes him a really unreliable guide for the true underlying value of the business.
But then, on other days, Mr. Market gets incredibly gloomy. He's deeply pessimistic, he thinks the sky is falling, doom and gloom are everywhere, and he offers to sell you his shares at ridiculously low prices. Graham's lesson here is just so powerful. As investors, we should never, ever follow Mr. Market's wildly swinging emotions. Instead, we need to look at these mood swings objectively and actually take advantage of them. You buy when he's irrationally pessimistic, and you sell when he's blindingly optimistic.
That brings us to Section 3, investing versus speculation, the crucial distinction.
Now, what's really interesting about this next concept is that it forms the very backbone of Graham's entire philosophy. It draws a crystal clear line in the sand between two totally different things. Investing involves careful, thorough analysis. It's about protecting your capital first and foremost and seeking a reasonable, justifiable return based on actual math and business fundamentals. Speculation, on the exact opposite hand, that's just guessing future price movements. It's rolling the dice on whether a squiggly line on a chart is going to go up or down. Graham strongly encourages us to stay firmly focused on the rational pursuit of reasonable returns rather than the absolute danger of mere guesswork.
Next up is Section 4, your margin of safety, the ultimate buffer.
We are now covering what is arguably Graham's absolute most critical concept for protecting your hard-earned capital over the long run: margin of safety. This means strictly buying assets at prices significantly below their calculated true value to create a buffer against mistakes and market downturns. By insisting on this discount, you're basically building in a tangible cushion. It's like a financial shock absorber. It means that even if your initial analysis is slightly off, or if unexpected terrible events hit the broader economy, you have this built-in layer of protection. This buffer is literally your financial lifesaver.
Let's continue to Section 5, two types of investors, choosing your strategy.
Because once you understand these core principles, you have to choose a personal strategy that actually fits your lifestyle, your goals, and your available free time. Graham divides us into two distinct categories. First, there's the defensive investor. This approach is simple, it's low maintenance, and it relies heavily on broad diversification. It's perfectly designed for those of us who want a solid financial future, but don't really want to think about our portfolio every single day. Then, you have the enterprising investor. This person is willing to put in serious, continuous time and effort to research specific opportunities in search of better than average returns. And you know what? Neither path is wrong. Both are incredibly valid as long as your choice is intentional and you're honest with yourself about how much time you're actually willing to commit.
And finally, we arrive at Section 6, Mastering Your Emotions, the final hurdle.
So, the crucial point here is that this addresses the ultimate, and without a doubt the absolute most difficult challenge every investor faces: themselves. Your own emotions are your biggest enemy in finance. Fear and greed naturally lead people to make terrible decisions. When the market is booming, greed makes people rush in to buy at the absolute top. When the market drops, fear causes them to panic sell at the absolute bottom. It's the classic, devastating trap of buying high and selling low. To win this game, you absolutely must cultivate discipline and patience. Successful investors drown out the noise, they ignore the daily fluctuations, and they stay fiercely focused on their long-term goals.
Ultimately, if you take nothing else away, remember this profoundly reassuring truth from the intelligent investor. Wealth is built not through excitement or luck, but through knowledge, patience, and consistency. It's a remarkably anti-hustle message in a world that is totally obsessed with overnight success. Good investing is often boring investing, and honestly, that is exactly how it should be.
To bring it all together, remember Graham's golden rules. Think independently. Avoid emotional decisions. Maintain a margin of safety. And invest for the long run. These principles were written way back in 1949, yet they remain just as vital and deeply relevant today as they were when the ink was still wet on that very first edition.
I want to leave you with one final provocative question. Tomorrow morning, when Mr. Market inevitably knocks on your door with his erratic prices and his totally wild mood swings, are you going to follow his emotions or are you going to take advantage of them? Because you are empowered to make that choice. Shift your mindset from emotionally reacting to rationally investing. Thank you so much for joining me on this explainer. Until